This will focus on investments or securities investment. What are the functions of the JSE? Guys, this question comes around every single time. The main thing that I want you to realize is the JSE does not sell the shares. It's basically a place where it links, look at dot 3, the investors and public companies. So they are the middle person, the intermediary between these two. They don't sell it, they're just there to help regulate. Okay. If I look at the first dot, they act as an indicator of economic conditions. So they will tell us what's happening with these big companies, and then that will tell us what are impact the inflation rate, the interest rates, etc. It also keeps the investors informed because if there is a change on the share price, they publish everything. They evaluate and value the shares, okay? They help companies to raise primary capital. Primary capital is own capital. They regulate the market for dealing with shares, so no person can just quickly pop up and say, I'm now a public company. It has to happen through the JSE. They regulate that, and therefore they look after both the companies and the consumers. They plan and research and advise people on the different investment possibilities, and they also make sure that transparency is a very important focus here. So if there is discussions of people who might be corrupt, they will tell you about that. Know the functions of the JSE. Then there are 4 types of main shares. The first one is your ordinary shares. And guys, ordinary shares are the shares that we get on the JSE quite easily. They usually have a much higher net profit. They have a very high risk compared to the other types of shares. And the reason for this is they fluctuate constantly. Okay, so there's a big chance for you to lose your money as well. If we look at preference shares, the second type of share, these shares have a certain preference or certain extra rights. They don't fluctuate as much, so the risk is much lower, but you are basically guaranteed to get dividends. Where with ordinary shares, there is no guarantee of it. If we look at founder shares, if I start my own company, I will be known as the incorporator and I will have founder shares that belongs to me because it's still my company even though I sell a piece off to the public. Sometimes if I cannot afford to give out dividends, I then reward my current shareholders by giving them bonus shares. Okay. And then in the future, they can collect more dividends on that shares that they own. When I look at my different types of preference shares, you have participating, and guys, this just means that the shareholders will get them fixed dividends, but if there are more profit made, they will also get more profit, so they will benefit in that. When non-participating preference shares, you only get your dividends for the year. It's fixed. Even if the business makes more profit, nothing. You get your fixed dividends. Cumulative shares, if if you have a cumulative preference shares, you will get, and they don't pay out dividends this year, you will get dividends on this year plus the ones that you missed. Non-cumulative shares, you only get dividends this year, but if no dividends can be paid out, it's going very bad, then you will not receive dividends for outstanding years again. Redeemable, this means that the shares can be bought back by the issuing company. So basically, this is a preference share that has a due date. So at a certain point, the company is going to buy it back and give you your money back. Where non-redeemable says the shares are only bought back when the company closes down for reasons other than bankruptcy. Okay, so if they go bankrupt, you lose your money. Tough luck. Then convertible can be converted into ordinary shares after a certain period of time. Where non-convertible shares, it remains a preference share. Now, one of the reasons why some people will want to convert is because ordinary shares have higher dividends. Not fixed, but higher. And guys, when you need to be able to distinguish between these two. Ordinary shares only receive dividends if profit is made. Preference shares, you get your dividends regardless of whether profit is made or not. Ordinary shares, higher the profit, higher the dividend. Preference shares, fixed dividend. Then ordinary shares, if the company is liquidated, they are the last to get some money back, where preference shares, after the debtors have received their money, the people who the debtors, then preference shareholders will get their money back. Then ordinary shares can vote at the AGM. Preference shares, their shareholders cannot vote at the AGM, only if they need to break a tie or something like that.